Hey guys, welcome to this week's podcast episode. And I've got a fantastic guest for you today, Steve Hovland. And he's going to talk to us all about are you ready to delegate your CFO? And this is kind of an interesting topic and conversation for the audience. This idea of a fractional CFO. And he's got a very extensive background. And I'm really happy to welcome Steve to the show. Welcome, Steve.
Thank you, Christopher. Thank you for having me.
Yeah, I know we connected through Podmatch and kind of give a brief overview of what you do, very briefly how you got there and how you can help the audience with your expertise.
Sure. So I'm with Delegate CFO, and we do virtual and fractional CFO services. And what that is we work with the small and medium businesses that they need CFO help. They need that expertise, but they don't necessarily need a guy sitting there 40, 60 hours a week at a desk. They really just need, kind of the part-time help to help with how to do budgets, how to do forecasts, how to analyze the profits, the profit margins on their products. They just need kind of that high-level help. They need, maybe 10, 20 hours a week max, and then periodically a quick consultation each week to discuss, thoughts on a new product line, how to make their budget work, so on and so forth. So, and I kind of came across the idea, there's several competitors out there in the virtual CFO world. But I used to be an audit partner with a 100-person CPA firm. And I was actually the director of audit. And as you go through and you audit companies, whether, I've audited multi-billion dollar companies to small couple $100,000 companies. And one thing I commonly saw was more the medium-sized businesses, they needed this help, but again, they either one didn't have the budget to have, somebody sitting there for, 170,000 a year, or they just didn't have a whole lot there that they needed somebody there. And so with my 20 some years in public accounting, I thought, back in 2019, this is something that really people really actually need. And from my standpoint, I really do enjoy teaching the business owner how to do a budget. We're going to start at a 30,000 foot level. Where do you want to be net income wise? Okay, now let's start breaking that down. And you start going through the process so they can kind of get an understanding of where they can be and how to get to that particular area.
Yeah, really great introduction, and I'm really excited to delve into the conversation. And one thing is talking about is this first thing is what do you mean you say it's so important about break even? We've all heard this term, but what is it in your context and how is it applicable?
So break even on a very high level is your sales are enough to cover your expenses, both your cost of goods sold and your operating expenses. So theoretically, if you had one product, we'll call it product A, and the sales for that product are enough to cover the expenses, your net income theoretically for that product would be zero. You wouldn't have a loss or gain, would be zero. That's one way to think about the break even on a product. And it's important to understand where your break even point is on your products or services divisions. Because you want to make sure that you're selling the product or service at a correct price and you're covering all your costs. You're not losing money on the respective product or service. And so that's one of the key aspects with that we work with our clients is we say, okay, first we want to know what the break even point is. And a lot of times we have to do kind of, again, a high level calculation at first. We say, okay, what are your operating expenses as a percent of your sales? And so I tell them, okay, whatever that percentage is, that's what your gross margin needs to be on that product at a minimum. And, yes, you could have a loss leader in there that brings in something else that has a higher margin. But for the most part, everything should cover all your operating expenses. And so that's kind of where we start when we go through on the break-even process with our small and medium companies so they can understand, hey, this is a great product. It goes out the door a lot. But then we do the numbers behind it and say, well, you're actually losing $1 for every transaction type situation. So you're not going to make it up on volume. You're just going to make more loss. So.
Yeah, that's really that's a very I mean I thought it was something more to it, but the next kind of follow-up question is, so when you talk about, maximizing gross margins and, what constitutes because you hear these gross margins, in different industries and, like for example, restaurants, they're thin, razor thin margins and, versus like, software companies, what constitutes good and what strategies can businesses employ to maximize their gross margins?
So the first part, again, it kind of goes back to the break even. First, we want to know, maybe take a step back. Gross margin is your sales less your cost of goods sold gets to your gross margin. Net margin is more or less your net income divided into your sales. So for the gross margin, we want to know first what the break even point is. So again, we kind of go back to that formula of here's your operating expenses divided into your sales, whatever that percent is. Let's say it's 10%. So we know that our gross margin percent has got to be a minimum of 10%. So we say that that's our floor. We can't go below that. It goes below that, we're not selling that product. Now we need to look at, okay, now we know what our floor is. Now we have to say, okay, what can the market sustain for a sales price? So if you're selling a widget and let's just say the break even is $10 and you can sell that widget for $12, well, then that kind of gives you an idea as to how you can maximize out your gross margin. The other thing that you can do is you find out what the margin percent is for your industry. So there's industry guidances out there. And here at Delegate CFO, we use IBIS World, IBIS World, and they have a whole bunch of industries out there, all sorts of different analytics. So you want to figure out what is what are your competitors getting for their margin? And then you can bring that to yours and say, okay, if the competitors are getting, 20% and I'm at 10%, okay, so that means I can increase my sales price. But then you look at your sales price and if you can't max it out to get to that 20%, then that tells you I have some inefficiencies I need to take care of, whether it's labor, materials, wherever it is. And so that's how we start we start going through the process and say, okay, here's what the industry is. Let's say it's 20% and you're at 10%. So first we say, okay, can we just increase the sales price? That's the easy part. But if we know the market won't sustain that, then that tells us, okay, to maximize that gross margin, we have inefficiencies. So we need to figure out what the inefficiencies are. Is it labor? Is people just not cranking out the number of widgets that we want? Is it possibly materials, overhead, what have you? So we start breaking it down. We start figuring out what the drivers are for that. And so we get to that point that we can maximize that gross margin. Because ultimately, you maximize your gross margin, it's for the most part going to go straight to the bottom line because most of your operating expenses are going to be fixed. It's whether you sell one widget or 100,000 widgets, usually it's going to be fixed. I mean, there are some variable costs in there, but for the most part, they're fixed. And so that's why we want to try to maximize that gross margin as best we can.
Yeah, I love how you describe that, and for the audience, it's really beneficial because a lot of these they're specialists, but they don't have and that's why it's important to kind of get a grasp, but also hire professionals. Next question is this idea of cost accounting simplified. Can you provide a simplistic version of cost accounting that small and medium businesses can easily implement?
Sure. And this kind of goes back into the gross margin. So cost accounting is really looking at, again, like the term describes, the costs that go into your product. So when you're building a widget, or even if you have a service, you're going to have your primary costs, whether it's direct materials, direct labor, and then you're going to have overhead. And overhead is always kind of that cost that can't be identified directly to a particular product or service. So if we have a widget, we know it. The material itself, the steel, let's say, costs $10, per unit. That one we know we can control that. Then it takes 1 hour to produce that. So there's the hour that goes into that, and then it's the overhead part, and the overhead can be allocated. And to take a step back, overhead really are costs that are necessary for, say, like if you have a manufacturing plant, you have to have insurance on it. You've got utilities that are going to all the machines, but you can't say this is specific to this widget A or widget B or this service. And so you have to allocate it out. And so what you want to do if you're overhead is say, okay, here's all these costs that I can't identify specifically to a product. but they have to incur some of these costs because it was necessary to produce that product or that service. And so then you get your overhead, and then you come up with a method to allocate it. Now, you can allocate it based on direct labor hours. You can do it machine hours. You can most time, if you're a service industry, you set up kind of what's called an overhead rate, which that is usually you take last year's total overhead, last year's labor rates, or total labor hours, and you come up with just a simple rate, and then you allocate that for the next year type situation. So, but it's always important to understand that when you're building a product and or service, you're going to have three main costs. You're going to have materials if it's a physical product, labor for both sides, and then you have overhead. So you got to make sure you capture all that, because that's truly the cost. It is truly what it costs you to build that product or that service. And so that's really what cost accounting does. Now, there's a bunch of complicated stuff in cost accounting on spoilage and abnormal spoilage and all that stuff, but that gets into the very, very complex realm. So we just kind of push that to the side because we know it's out there, but we want to just simplify as best as possible so we can truly understand how much are we making, or how much is the company making on those products or services.
Yeah. And I love this, and kind of I'll one thing is talking about is we kind of talked about kind of the basics that you handle. Talk about so for a lot of the individuals, they're not they just kind of want to understand this and then hire some. So the importance of internal controls, and what are some essential internal controls that businesses should have to ensure financial accuracy and prevent fraud. And then talk about when should businesses start to hire a fractional CFO, what like revenue, size, margins, all of that.
Sure. So one of my designations, obviously I'm a CPA, but I'm also a certified forensic accountant. So my other aspect of my company is I do forensic accounting, fraud investigations, usually to do testify in court. But one of the most important things when we onboard a brand new client, we'll go through their internal control structure. The reason being is you want to make sure that errors can't happen. There's a breakdown on how information is going through, because one of the worst things is to give a client a set of financial statements that are inaccurate. You had the wrong, you had an asset sitting in there when the reality was expense, because they can make bad future decisions on bad information. So first we want to go through the internal controls to understand what are the controls, who's doing what, how to make sure we don't have errors. If it's a manual entry, well, let's see if we can automate it so we don't have somebody fat finger transpose. The other part is to make sure that nobody has the ability to, the fancy term is misappropriate, but it's really steal money from a company. There's a bunch of fancy terms out there, but in reality, if you ever hear the term misappropriation of assets, it's really theft. And so we'll go through to make sure there's no opportunity there, or there's no review in place to make sure that opportunity didn't happen. And so the importance is, if you think about it, if somebody works for your company and they steal, say, $1,000, and your net margin, so your net income divided by your sales, let's say it's 10%. Well, that means you have to earn another $100,000 in sales just to recoup that $1,000. And so, I'm sorry, $10,000. And so that's what's important to people to know is when somebody steals from a company, they're stealing from the bottom line. They're not stealing from the sales. They're stealing from that net income part. And to recoup all that, you have to have whatever your margin percent divided into the amount they stole. That's how much more sales you have to get just to get recouped from the theft. So that's why we say, let's make sure we understand what the controls are and how to make sure they're in place. Now, a lot of times you'll hear the term segregation of duties. And what that really means is there's 4 key areas in internal controls. There's authorization, there's recording, there's custody of assets, and monitoring. Now, in the quote textbook ideal world, you'll have one person doing a separate person on each area. In reality, especially for the small and medium businesses, you have 2 people doing all those aspects. The key is when you have a smaller company is the monitoring function should be done by hopefully the owner of the company. If the owner of the company isn't able to, then somebody who's outside of the other aspects. You never want one person to have access to all four of those areas. And so that's why whenever you see a news article about segregation of duties, it's because somebody had access to it all. Now, depending on when you listen to this podcast, I would recommend to the viewers or the listeners to go into Google, type in bookkeeper fraud, and then do the same thing again a month later. You will have 10 news stories pop up, and then you do it again, there'll be another 10 news stories pop up, and they're all different. And if you read the stories, probably 90% of the time, there was lack of segregation of duties, i.e. the bookkeeper was able to do everything, and more importantly, there's no monitoring happening. And so that's why it's key for us on our CFO side is we want to make sure all the controls are in place. We understand who's doing what, who has access to it, and how to monitor it. Now, the second part to your question is, when should somebody bring on a virtual CFO or fractional CFO? It's not always dependent on revenue. Ideally, we say usually you want to be about $1 million plus in total sales to start bringing on the CFO. But it's really when you're getting to the point where you need to understand your budget, you need to forecast out. And especially if you're expanding, you're a new company, or you've been around and you want to maximize your profit, that's when you really want to bring on the CFO. If you're just starting out and you're kind of building everything, that might be a little overkill at first, but my recommendation is if you're at that point, make sure you start doing budgets, because I don't have the statistics, but my gut says about 90% of small, medium businesses don't do budgets. And, and I forget who said the quote, but there's a quote out there that says, if a number can be measured, it could be managed. Well, if you're not measuring your budget, it's really hard to manage your current fiscal year. And so when you bring on a CFO, you really want to bring, if you're at the point of about $1 million plus, then it's ideal to bring on a fractional virtual CFO. Usually when you get up to, say, 30, 40 million, that's when you kind of get to the point where you need to have somebody physically there. Because when you're at that level, you probably have multiple divisions, multiple things going on, and you truly do need somebody sitting there. So that's kind of like the range in there. But again, the most important aspect is if you're not quite to that million range yet, make sure you're doing budgets and forecasts, even if it's very simplistic, because that'll help you manage your company. One thing we've said before is, the budget, think of it as it's your destination. If you were going to go from Colorado to, let's say, Las Vegas, that's your destination. And your forecast is, how am I going to get to Las Vegas? And so always kind of keep that in mind. For the fiscal year, you want to make $1 million net income. Well, how are you going to get there? Now, that's how you start forecasting. And then you can start breaking it down even more. Okay, how much per month do I have to do to get to that? Okay, is that reasonable, type situation? So you start breaking it down more finite, but you got to start at some level. So always start at the highest level.
Yeah, I really enjoyed this conversation, and it kind of reminds me because I have that's why, for example, like I like to just hire out things that I need, so that ultimately I have control and oversight on a lot of things. And it's interesting because like one of my, I talked to a lot of my other colleagues, and they're like, when they have a very large company, even one person does not have it has to have like get approval through like 3 or 4 different channels. And so even the CEO does not have access to all of the, that prevents, fraud and all these bad things. So if people want to reach out to you and check out your work and check out your socials, how can they do that?
You can go to delegatecfo.com, and throughout the website we have different services. So we do have like virtual controller services. So if you're not quite to the CFO level, we do have the controller services. And then we've got a whole bunch of information on the different aspects to either CFO or cash flow, free cash flow, internal controls. We also have a YouTube channel at Delegate CFO on YouTube, where we put up videos so that, because sometimes, as we all know, you can put a big old blog on there, but it's easier just to watch a video. So we put videos up there as well.
Yeah, I love that. And for all the audience, let's thank Steve for coming on. And be sure to give his socials a like and follow, and check out his links if you're interested in working with him, and when it makes sense to hire a fractional CFO. And yeah, thanks so much for coming on the podcast in such an enlightening conversation.
Thank you for having me, Chris.